Let's cross now to Cape Town, where I'm joined by Graham Bell. He joins us there. He's from Old Mutual Equities to give us perspective on the global market performance. Graham, good to have you with us today. Just last week, all eyes were on China. A few weeks before, all eyes were on Greece. But tonight, all eyes on the US following the CPI data, together with the FOMC minutes, which are highly anticipated to be released later on this evening.
Hi, Gugu. Yes, all eyes on the US, but US eyes on China. So the CPI data today, as you mentioned earlier, was 0.1% up in a month for the core rate as well. This was probably below expectations and was an indication that inflation is still not an issue, particularly following the prior 2 months where there had been quite a sharp uptick in headline inflation, mainly because the oil price had bounced. But now the oil price has been coming back down again, and next month's CPI in the US will incorporate that further decline in the oil price as well. So inflationary pressures are certainly not a big issue in the States, as also has been the case with wage pressures, where we've seen very muted wage increases and less than expected in the case of the employment cost index, the quarterly index that came out a couple of weeks ago. So the Fed minutes, you must remember that the Fed meeting guided to a rate hike if there was some further improvement in the labor market, and we actually saw that some further improvement in the last payrolls numbers. They were pretty good. They weren't stellar, but they were good enough. But the other thing to remember is that the Chinese devaluation came after that Fed meeting, and it was a surprise. So everybody's been expecting that China might allow their currency to weaken a little bit, or they might widen the band. They were trying to become part of the SDR basket and so on. But the move that they made indicated that there was a bigger devaluation in possibility, and that could continue for some time. And the problem with that is that other currencies then feel obliged to devalue as well. So China then effectively starts to export its deflation. And in fact, today you might have noticed that we saw 2 Asian currencies announce devaluations in Vietnam, the Dong, and in Kazakhstan. And this is just a further sign of the pressures that this slightly unexpected cut in the renminbi or devaluation in renminbi would have around Asia and other emerging markets.
Graham, continuing with this theme of the influence that China continues to have on the market, do you think it will play much of an influence post the minutes we see today on the Fed's decision for interest rates to hike up in September or push it further to December?
I think there is a chance they may delay it now. There is actually a meeting in November as well. The Fed meets every 6 weeks, but usually they don't do a rate hike except in the quarterly meetings, because that's when they have their press conference. So the early November one is highly unlikely. But there is a possibility now, because weaker currencies around the world mean a stronger dollar, and the dollar's already been strong, and a firmer dollar tends to rein in US growth. And growth is the issue for the Fed. If there's growth, then there could be inflationary pressures, and the currency is appreciating. That also helps to keep inflationary pressures at bay. So suddenly it's become less certain now. I think a month ago, 2 months ago, forecasts for the Fed hike converged very strongly on September, and that's been thrown into doubt now by the Chinese move. Having said that, I don't think it's the Chinese intention really to significantly devalue their currency. For one thing, Chinese corporates have $700 billion worth of dollar-denominated foreign debt. So devaluation puts further pressure on them, and they've been going through a tough time recently because the economy's been slow and they have negative PPI. So I don't think that the intention of the People's Bank of China is to have a significant devaluation. I think they'll let it ease off gently, and in due course I think people will start to relax and stop worrying about it so much. And that will probably, assuming that the US labor market data next month, the next payrolls data that comes out, is also as strong as the last one, then I think the chances of a Fed hike are still pretty high. Beyond that, of course, is the issue, just what will the trajectory be? And Janet Yellen has consistently guided to a much lower trajectory than in previous rate hike cycles. And I think that will just still be the case. So always I go back to the point as, you know, the rates are still very, very low. You've got 25 bip Fed funds rate. If they hike it, it gets to 0.5%. If they hike it again, it's 0.75%. These are all still very, very low interest rates. And if they do that slowly over time, then I don't think the markets are going to be too spooked.
Just to close off with, though, Graham, looking at the global equities market, it does seem as though there's an increased vibe of volatility. Is that something that you think might still be maintained on the market until we get some kind of clarity from the US?
Yeah, there's loads of blood out there today, and the all share index is flirting with the 50,000 level, which is, you know, I mean, 50,000 isn't necessarily a level that it has to hold, but it is a kind of headline type of number. And markets have been weak, and I think it's not just volatility, they've been trending down recently as well. I think equity markets are starting to get reasonably good value again, and yes, I think the volatility will still be there, but I don't think it'll be extreme because a lot of this is being priced in now. So I've been a little bit surprised how weak it's been, but I think that in due course it will settle and people will start to rethink and they will see some better values around there, and I think the markets will start to regain their poise.
Graham, thank you so much for your time today and analysis of the global market space. That was Graham Bell, strategist at Old Mutual Equities.